Today, we're digging into something pretty exciting, Ryan Bolt's systematic blueprint for finding multi-bagger stocks. And we're not just talking about decent winners here. We mean the really rare ones, the 10x, 20x, maybe even 100x returns, the kind that can, potentially build serious wealth. Our mission today is to cut through the noise and really extract the system Bolt lays out. It's this mix of hard financials, market timing, and maybe the toughest part, the psychology you need to actually hold these things long enough. The hook, obviously, is Bolt's own story, turning $10,000 into, $574,000 with Tesla, TSLA. That stock went from around $5.60 back in 2012 to over $300 by 2025. That's a 5,645% gain. Huge. And the idea is this wasn't just a lucky bet. It was supposedly a process you can follow.
Absolutely. Yeah. And it's really important we nail down what a multi-bagger actually is. It's not just a stock doubling. It has to show that sustained exponential growth year after year. Think about NVIDIA, NVDA. That's another great example. Went from about $10.25 in 2015 to $167 a decade later. That's a 1,500+% gain. Turns 10 grand into, $162,900. And what gives Bolt credibility, I think, is that he's upfront about his misses too. He admits he missed NVIDIA early on. Why? Because he hadn't fully grasped one of his own key principles yet. It shows it's a learned system, built from real experience, not just theory.
Okay, so let's unpack that foundation then. If you want a stock with that kind of potential, that explosive capability, what does it absolutely need to have before we even think about charts and timing?
Right, he boils it down to three core pillars, non-negotiables. First, really aggressive revenue growth, fast growth. This isn't about slow and steady, it's pure expansion. Second pillar, a strong competitive moat, something unique keeping others out. And third, it has to be perfectly aligned with a massive, unstoppable market trend. Like you said with Tesla, that huge gain wasn't just the car, it was riding the whole global shift to EVs. Or Apple, right?
Yeah.
That 3,300% gain came from building that incredibly sticky ecosystem. You have to be surfing a giant wave.
That makes sense. Fast growth, protection, big trend. But here's something interesting Bolt points out early on. Even if you find all that, volatility is basically guaranteed, right? He talks about a moment in 2018 with Tesla. Sheer panic during a big dip. Most people would sell there. How did he manage to stay in?
Yeah, that's a crucial lesson. He used data to override the fear. He held because the fundamentals hadn't actually changed. Tesla still had, $21 billion in revenue then? The core business was strong, still growing. And here's the kicker. He mentioned checking TradingView data later, that big volume spike during the dip, around 12 million shares. It actually marked the bottom. It wasn't signaling a crash continuation, it was signaling capitulation, the turning point. So the lesson is you need that fundamental conviction, but you also need technical confirmation sometimes just to survive the shakes.
Okay, that difference between belief and actual market confirmation, that leads us right into the toolkit. Fundamentals and technicals, we know we need a healthy company. But for these super growth stocks, these potential multi-baggers, what metrics really matter? It can't just be the old value stuff.
Exactly. Bolt zooms in on revenue growth, naturally. Then EPS, earnings per share, ROE, return on equity, free cash flow, FCF. And keeping an eye on the debt-to-equity ratio, making sure it's manageable. But, and this is really important, maybe not obvious for a multi-bagger, R&D spending often tells you more than current profits.
Okay, R&D. Tell me more about that. Why is that the secret ingredient that might separate just a good company from a 10x winner?
Well, think about it. Exponential growth needs constant innovation, constant reinvention. Bolt directly says his big early miss on NVIDIA, back when it was just $10.25, was because he underestimated how much they were pouring into R&D, future investment. By 2023, NVIDIA's R&D budget was huge, $7.3 billion. That signals management is aggressively reinvesting everything back into dominating the next cycle. They're essentially buying future growth. If you see a supposed high-growth company cutting back on R&D, that's a huge red flag. It suggests their edge, their moat could disappear. The multi-bagger dream kind of dies there. It's the fuel.
Right. So, okay, we found a company. It's got the fast growth, the moat. It's spending big on R&D. The fundamentals look solid. But how do we avoid buying it right at the peak? Or jumping in way too early before it takes off? That's the timing part.
That's where the technical analysis comes in. Fundamentals tell you what to buy. Technicals help you figure out when. Bolt uses the usual tools, moving averages, RSI, volume, Bollinger Bands, MCD, that sort of thing. But his main strategy is what he calls confluence. He looks for 3 or more separate technical signals to all line up and confirm an entry point. He claims this discipline bumps his success rate up significantly, maybe to 60, even 70%.
Confluence. Sounds disciplined, definitely. But isn't there a risk there? If you wait for 3 signals, aren't you potentially missing the very start of the big move?
That's the trade-off, exactly. You sacrifice maybe getting the absolute bottom price for a much higher degree of certainty that the move is real. He points to AMD back in 2016. The stock was flatlining, but the breakout around $2.80. It was signaled by 2 things at once: a golden cross on the moving averages, signaling upward momentum, and the RSI indicator breaking above 60, showing strong buying pressure. Confluence. And TradingView charts apparently showed something similar for Tesla's 2019 breakout around 86.7s. That was confirmed by a massive volume spike to 10 million shares traded. So, yeah, you wait for the market to kind of prove the fundamentals are starting to matter, even if you miss the first few percentage points.
Okay, shifting gears slightly. Beyond the company itself, Bolt really hammers home the importance of market trends. Like, even the best analysis can fail if you're swimming against the tide. We need those big industry tailwinds, right? What kind of sectors does he highlight?
Yeah, you absolutely have to be in sectors with huge global momentum. Things like AI infrastructure, electrification, maybe biotech breakthroughs. Trying to fight a dominant trend is usually just painful. Look at Royal Caribbean, RCL. That's a great example of riding a trend shift. It shot up 700% from its lows in 2020, around $44, to over $350 by 2025. Why? It just rode the massive, inevitable wave of the global travel recovery. And NVIDIA, again, it's still booming, not just because they make great chips, but because it's plugged into this projected $1 trillion AI market. That's like a hurricane pushing the stock price.
A strong trend still needs a good leader at the helm, though. How does Bolt suggest evaluating management? That seems, well, kind of subjective. Hard to put a number on leadership.
It is tricky, but you look for tangible evidence. First, yeah, visionary leaders are great, but you need to pair that with significant CEO ownership, skin in the game. Like Elon Musk owning, around 13% of Tesla. That aligns his incentives directly with long-term shareholders. Second, try to quantify the innovation. Check their patents. How much intellectual property do they have? Tesla, for example, has over 1,000 patents you can verify on uspto.gov. That depth of innovation builds that durable moat. We saw it with Meta too, right? Zuckerberg led that crucial pivot, and the stock jumped almost 300% from its 2022 lows. Decisive leadership matters.
Okay, and one last piece before we get into the psychology. The price you pay. Valuation. Seems obvious, but crucial.
Absolutely fundamental. Buying low is how you set yourself up for those 10x returns.
Yeah.
Bolt used UBR's dip in 2019 down at $30 as an example. The price-to-sales ratio got down to about 1.5, which he saw as an attractive entry. But he also shares a painful lesson here, a warning, really about overpaying for hype. He admits he bought NVIDIA himself near its peak, around $500, and then had to watch it fall hard later. So even if you find the perfect company, if you buy it at a crazy high valuation, you've basically killed your multi-bagger potential right from the start.
Okay, this brings us to what feels like the real challenge, the second half of the blueprint, the part most people probably ignore, the psychology of actually holding on. You can nail the analysis, find the perfect entry, but how do you survive those brutal 50%, 60%, even 70% drawdowns that seem inevitable on the path to 10x?
Right, and this is where having that systematic framework is designed to save you from your own emotions. Holding for those massive gains means enduring terrifying drops. The antidote he prescribes is strict risk management. Starts with position sizing. He mentions achieving that huge 1,100% gain on deal, from $10 to over $120. How? By apparently sticking to a small, maybe 1% risk allocation for that trade, you limit the damage any single stock crash can do to your overall capital. That's what lets you hold to the dip for the eventual recovery.
And are there specific technical tools he uses for managing that risk day to day?
Well, diversification is key, obviously. Don't put all your eggs in one basket. But for managing individual positions, he talks about using the average true range, the ATR. It helps you set sensible stop losses. The ATR measures volatility, right? So you set your stop far enough away to avoid getting knocked out by normal noise, but close enough to protect you if things really go wrong. It takes the emotion out of setting your safety net. It becomes a calculation.
Let's really focus on that mental side for a minute. You mentioned Bolt holding Tesla through that insane 70% drop in 2022. That sounds gut-wrenching. What kind of mental discipline, what strategies did he use to keep that long-term view and actually see it through to $322 by 2025?
Resilience is definitely the word. But he argues it's an active strategy, not just wishful thinking. Some of his methods include deliberately not checking prices every day. That constant noise just fuels panic. And he's big on journaling, like writing down why you bought the stock in the first place. Then during a crash, you revisit your journal. Has the fundamental reason changed? Is revenue collapsing? Is R&D cut? If not, the thesis holds. Think about that 2022 crash again.
NVIDIA's RSI hit 30, deeply oversold, triggering panic everywhere. Journaling would remind you, okay, the stock is tanking, but has the long-term future of AI fundamentally changed? No. So you try to override the panic signal from the short-term indicator.
Okay, so putting it all together, the analysis, the timing, the risk controls, the mental game plan, how does Bolt actually weave this into building a portfolio?
Yeah, it's about getting strategic exposure, not just owning random great stocks.
Yeah.
His 2020 portfolio example, the one that gained 250% by 2025, it wasn't just TSLA and NVDA. He also held RCL, the cruise line. So it's about balancing exposure across different high-growth sectors. He even mentioned using tools like TradingView's correlation matrix just to check how closely his picks move together. Like TSLA and NVDA had about a 0.7 correlation. They move similarly, but not identically. That ensures you're not completely wiped out by a shock hitting just one specific area. It helps the winners run while buffering the losers a bit.
Wow. What really strikes me is the sheer discipline needed to layer all this together.
Right.
You've got the fundamental deep dive, the technical entry points, checking the leadership, and these intense psychological tactics for survival. The case studies, he uses Tesla, NVIDIA, RCL, they seem to show that this whole multi-layered thing can actually work when it all comes together.
Exactly. I think the ultimate takeaway for you, the listener, is this. Finding multibaggers isn't like winning the lottery. It's not random luck. It's the outcome of applying a systematic, objective process, combined with, frankly, some serious psychological strength. You need that resilience to ride out the storms. You have to build a system strong enough to make you hold on when a stock that's already made you a lot of money suddenly drops 70%. That's the real test.
Bolt's journey, turning that $10K into over $500,000, it shows what's possible. But let's bring it back to you listening right now. What's the biggest barrier? Think about that agonizing 70% Tesla dip. Which part of Bolt's blueprint would be the hardest for you to execute? Is it the detailed R&D analysis? Is it waiting patiently for that perfect technical entry? Or is it the sheer mental fortitude to hold on through a crash like that? Figure out where your personal weak spot is, analysis or emotion, and maybe start applying this kind of systematic thinking there. And of course, the standard but crucial disclaimer, trading stocks involves significant risk. What we've talked about today, especially those past performance numbers, is absolutely no guarantee of future results. Please do your own research.